Assalamualaikum. We are from Group 2. Would like to present about Mr. DIY Company. I will introduce myself first. My name is NORSYAFIQAH binti AHYAD. My matric numbers is 296080. I will explain a little bit about a background of company Mr. DIY. Mr. DIY is a home improvement and lifestyle retail company that sells a variety of products such as household items, hardware, electrical, stationery, and much more. The company is well known for producing affordable and quality product, making it popular choice among Malaysian consumers. Since its establishment in 2005, the company has grown to become a major player in the home improvement and lifestyle retail sector. As a publicly traded company, the financial journey of Mr. DIY Group is meticulously documented in its annual report and financial statement. Investors and stakeholders may obtain detailed information on the company's performance, strategic initiative, and growth trajectory. Last but not least, the company's success may be attributed to its ability to evolve to changing customer preference, as well as its commitment to maintaining a strong and trusted brand presence in the retail sector. That's all from me. I will pass to the next presenter. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Farhana binti ABD.RAHMAN, matric number 291508. I will continue to present about the performance. Firstly, the current ratio. Current ratio, also known as working capital ratio, it measures a company's ability to meet short-term obligations that are due within 1 year. It shows a company's financial standing and demonstrates how to optimize current asset liquidity for debt repayment. In 2022, the current ratio shows 1.91 times, and in 2021 shows 2.01 times. It demonstrates how frequently the current assets of a business exceeds in its current liabilities. A company with a current ratio of 2.01 has 2.01 ringgit in current assets available to pay off debt for every 1 ringgit in current liabilities. The current ratio in 2021 is higher, 2.01 compared to 2022. It indicating better liquidity or ability to repay short-term debt. The current ratio in 2022 decreased to 1.9, and the ability to cover short-term liabilities with current asset decreased slightly compared to the previous year. Overall, even though both ratios shows the bank's ability to pay short-term obligations, their decrease suggests that the underlying reasons should be looked into more closely in order to guarantee that the business has enough liquidity to properly manage its short-term financial obligations. Next is the quick ratio. The quick ratio indicates how quick a company can pay the short-term debt using easily convertible assets. These assets are known as quick assets because they can be converted into cash very quickly. In 2021, the quick ratio was 0.62, and in 2022, it was 0.38. Thus, the company's capacity to cover short-term obligation using cash assets has changed over the last 2 years. A quick ratio above 1 generally shows that the company has enough cash to cover short-term debt. A ratio lower than 1.0 implies that the company may not be able to repay its short-term debts without liquidating more assets or taking additional loans. In the year 2021, the company had relatively good short-term liquidity. The company's short-term asset worth 0.62 for each ringgit of current liability that could be used to settle immediate obligation. A decrease in short-term debt paying capability of current assets of the company indicated by the quick ratio declined to 0.38 in 2022. According to the report, the company will have 0.38 ringgit highly liquid asset for every 1 ringgit in short-term debt in 2022. It means that there will be more pressure on financial resources to be made immediately. The cash ratio. The decrease within the quick proportion from 0.36 in 2021 to 0.19 in 2022 shows a noteworthy decrease within the company's short-term solvency and liquidity. This recommends that the company may have insufficient cash and liquid assets to meet its quick obligation, which seem possibly to lead to financial trouble. A cash ratio of 0.19 implies that for each ringgit of current liabilities, the company as it were has 0.19 in cash or cash equivalents to cover those obligations. This shows a potential failure to meet short-term financial obligation without offering other assets or raising extra financing. The total debt ratio, also known as the debt to asset ratio, could be a financial ratio that measures the rate of a company's assets that are financed by obligation. The reliable total debt ratio of 0.57 times from 2021 to 2022 shows that the company's Mr. DIY long-term solvency and financial use position have remained steady over the past year. This recommends that the Mr. DIY has maintained a direct level of use in financing its assets. While a steady total debt ratio can be a positive sign of financial stability, it is important to compare this ratio to industry benchmark and comparable to completely evaluate the company's position and financial risk. The debt to equity ratio, which measures total debt and financial obligation in relation to add up or to shareholder equity, could be a use ratio. This ratio, the proportion of debt to equity financing in a company's capital structure. The long-term solvency or financial use ratio, moreover known as the debt equity ratio, decreased from 0.14 times in 2021 to 0.13 times in 2022. This indicates that the companies of Mr. DIY dependence on debt to back its asset has likely decreased over the past year. A lower debt equity ratio recommends that the company Mr. DIY has a lower level of financial risk and is less dependent on debt financing. Generally, the decrease within the debt-equity ratio may be a positive sign for the company's long-term financial stability and indicates a more grounded value position relative to its debt. However, it is important to proceed monitoring this ratio and compare it to industry benchmark to completely survey the company financial leverage position. That's all from me. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURASYIKIN ABD and my metric number is 295728. Next, I will present about equity multiplier. Equity multiplier indicate how much of an organization assets are financed by value capital. It decreased within the equity multiplier from 2.35 times in 2021 to 2.32 times in 2022, shows that the company has slightly decreased its reliance on debt financing to finance its assets. It's also analyzing trend in the equity multiplier over a long time can give advanced knowledge into the company long-term financial health. Overall, the decrease in the equity multiplier suggests that the company has improved its long-term financial leverage position. Next, times interest and ratio. Times interest and ratio measure a company ability to meet each interest expense obligation based on current operating income. The increase within the times interest earn ratio from 10.38 times in 2021 to 10.85 times in 2022 demonstrates that the company ability to meet its interest obligation has improved. The change within the times interest earn ratio recommends that the company has strengthened its long-term solvency position, which could be a positive pointer of its financial performance. Furthermore, analyze trends within the times interest earn ratio over a long time can provide further insight into the company long-term financial health. Next, cash coverage ratio. Cash coverage ratio is a calculation that determines a company ability to pay its debts with its existing current assets. Cash coverage include as it were cash and cash equivalents. This does not include account receivable or inventory. The increase within the times interest earn ratio from 14.16 times in 2021 to 50.08 times in 2022 shows an improvement within the company capacity to meet its interest obligation and manage its financial leverage. Generally, the improvement in both the time interest earn ratio and the cash coverage ratio recommends that the company has strengthened its long-term financial position, which is a positive indicator of its financial performance. Furthermore, analyzing trends in this ratio over multiple years can encourage understanding into the company long-term financial health. Next, asset utilization or turnover ratio. The first one is inventory turnover. The decrease in inventory turnover from 2.65 times in 2021 to 2.13 times in 2022 shows that the company effectiveness in managing its inventory has declined. This may eventually affect the company profitability and cash flow. To address this decrease in inventory turnover, the company should conduct an intensive investigation of its inventory management practice. In general, addressing the decrease in inventory turnover is essential for optimizing the company working capital and improving its overall financial performance. Next, days sales in inventory. Days sales in inventory, sometimes known as inventory days or days in inventory, could be a measurement of the average number of days or time required for a business to convert its inventory into sales. The increase in days sales in inventory from 138 days in 2021 to 171 days in 2022 shows that the company is taking longer to sell its inventory. This increase in days sales in inventory also contribute to the decrease in inventory turnover and generally asset turnover ratio, indicating a decrease in a company effectiveness in utilizing its asset to generate sales or income. Overall, observing an analysis of this ratio will be necessary to track the company progress in addressing this issue.
Next, I will explain about receivable turnover, day sales in receivable, and total assets turnover. Firstly is receivable turnover. As we can see, the increase in receivable turnover from 24.05 times in 2021 to 29.67 times in 2022 is a positive sign for the bank. This indicates that the bank is collecting its account receivable more quickly, which can improve cash flow and liquidity. A higher receivable turnover ratio also suggests that the bank is effectively managing its credit and collection policies, which can decrease the risk of awful debt and improve general financial health. Overall, the increase in receivable turnover ratio indicates improved efficiency in managing the company accounts receivable, which can have a positive impact in its financial performance and overall operation. Continued monitoring of this ratio will be important to ensure that the company maintains this positive trend in its receivable management. Next is day sale in receivable. As we can see, the decrease within the day sale in receivable DSR ratio which from 15 days from 2021 to 12 days in 2022 is the positive trend indicated by the increase in receivable turnover ratio. A lower DSR ratio means that the company is collecting payment from its customer more quickly, which is a positive sign for its financial health. This improvement in DSR ratio recommends that the company has been more effective in managing its account receivable and collecting payment from its customer in opportune way. Overall, the increase in receivable turnover ratio coupled with the decrease in DSR proportion indicates that the bank is performing well in managing its account receivable and generating cash flow, usually a positive indicator for the company's financial health and efficiency. Last from me is total asset turnover. In this case, as we can see, the company total asset turnover decreased from 1.25 times in 2021 to 1.20 times in 2022. This recommends the company's ability to generate revenue from its asset has declined slightly. There can be a few reasons for this decrease, such as a decrease in sale and increase in total asset without comparing increase in revenue. It is important for the company to analyze the factor contributing to this decrease and take suitable measures to improve its asset utilization and in general performance. This may include reviewing its resource management strategies, identify areas for improvement, and actualizing change to improve efficiency and profitability. Furthermore, comparing the company performance to industry benchmark can give important insight into its competitive position and potential area for improvement. That's all from me. I will pass to the next presenter. Thank you.
I will continue about profitability rates. Firstly, profit margin. The profit margin for year 2021 is 12.81%, and for the year 2020 it was decreased to 11.89%. Second is about return on asset (ROA). The return on asset for year 2021 is 16%, and for the year 2022 it was decreased to 14.26%. Last one is about return on equity (ROE). The return on equity for year 2021 is 37.59%, and for the year 2022 it was decreased to 33.07%. I will continue to present about suggestion or solution for the company to improve their performance. Mr. DIY Group should carefully manage its current ratio to keep it over 1, avoiding short-term solvency issue, optimizing inventory management and streamlining accounts payable and receivable will improve this key ratio. A careful approach to the quick ratio and cash ratio will ensure that the company has enough liquid asset to quickly pay its debts, improving financial stability. Mr. DIY Group should aim for a balanced total debt ratio for long-term solvency. Its capital structure should include a balanced mix of equity and debt. Effective debt-equity ratio management and a stable equity multiplier will boost the company's long-term financial health. The company's ability to pay interest using operating income and cash flow must be monitored, as shown by the times interest generated ratio and cash coverage ratio. Next, in asset utilization ratios, inventory turnover must be optimized through inventory management. Faster inventory turnover increases cash flow by reducing inventory days. Boosting the pace at which receivables are turned into cash allows rapid payment collection, boosting cash flow efficiency. To evaluate its profitability ratios, Mr. DIY Group should review its cost control and revenue enhancement strategy. ROA calculates asset utilization profit potential, while ROE may involve financial leverage optimization and total profitability. The methodical computation and analysis of these financial measures allows Mr. DIY Group to understand its financial performance, identify areas for improvement, and make informed strategic decisions, maximizing business success. Next is about Mr. DIY Group's success depends on its financial stability, which boosts shareholder confidence and attracts investment. This is achieved by financial reporting transparency, risk management, and debt management caution. To boost shareholder confidence, companies must pay competitive dividends, repurchase shares when necessary, and allocate capital efficiently. Improved confidence requires consistent investor interaction, strict company governance, and diversification for resilience in stormy market. A well-defined financial strategy, cautious risk management, and ethical corporate behavior may help Mr. DIY Group become a reliable investment with a steady financial base. Conclusion: the assignment highlights the importance of Mr. DIY Group Berhad in the retail market, particularly in DIY. The steady rise in financial growth and the ability to execute expansion objectives indicate strong leadership and a business model that can meet consumer needs. Despite knowledge, the task has been difficult. Researching a stock exchange-listed company, which requires analyzing financial data, corporate reports, and market analysis, was difficult. The complexity of analyzing financial statements and negotiating the dynamic retail industry made it difficult to acquire relevant data for a thorough analysis. The data is useful for understanding corporate environments and financial markets. This experience helps us understand complex organizational structure and financial matters. That's all from us. Thank you.